Hey everyone, welcome back to the Weekend Charts. I'm your host, Charlie Bilello. As always, a lot to discuss, so stick around to the end. If you're watching this on YouTube, hit that subscribe button for more content just like this. And I want to start out, of course, with that CPI report. Huge report. We were expecting it to be good, and it was better than those expectations. So the road to lower inflation continues here. We have that overall rate of CPI moving down to 3.2%. Estimate was 3.3%, so a little bit better there. And that core rate of inflation, which excludes food and energy, moving down to 4%. This is something the Fed looks at very closely, so important factor there. And people were expecting 4.1%, so a little bit better there as well. That's the lowest rate of core inflation in the US since September 2021. So how did we get here in terms of the overall rate of inflation being 3.2% today? Whereas in June 2022, we peaked at 9.1%. Well, it's being driven not just by one component, by most of the major components here. You can see things like fuel oil, gas utilities, gasoline, all down year over year, whereas in June 2022, they were up sharply. We were seeing commodity prices spike at that point in time. Now, down year over year, things like used cars still moving down year over year, and other things like new cars, where we're seeing huge price inflation in June 2022, now up just 1.9% year over year. Now, what are the two areas that we're still seeing higher inflation today than in June 2022? Number one would be transportation, 9.2% increase versus 8.8% back in June 2022. And number two, and this is by far the biggest component of CPI, shelter, showing a 6.7% increase versus 5.6% back then. But the important thing to note, of course, with shelter, as we do every month, is it's a severely lagging indicator. So it's not reflecting what's going on today. It's reflecting what went on really over a year ago. And we can illustrate that by looking at the comparison of shelter CPI to actual apartment data in terms of listed rents. And you can see here in the blue line, apartment rents are actually lower than they were a year ago in terms of the average asking rent, down 1% over the last year. So shelter CPI is really just starting to reflect this lower housing inflation that we've seen for at least the last 6 months in terms of the actual data. And so the good news is it's just starting to reflect this, and it's likely to reflect it even more in the coming months. So this 6.7% rate of shelter inflation was the 7th consecutive month of lower shelter inflation. We peaked out earlier this year at 8.2%. And in the coming months, we should see this decline even more, because it's going to play catch up here with the actual data. And what has shelter CPI been doing over the past year and a half, as we've been talking about? Well, it's closing this gap with the actual data. So in 2021 and the first half of 2022, we saw that just this enormous increase in home prices and in rents, and shelter CPI was not reflecting it. And so we were saying, this is crazy. Inflation is actually much higher than what the CPI is showing, because shelter inflation is understating the true rate of inflation. Now we have the opposite situation, where shelter CPI is overstating the current rate of inflation, and that's likely to continue for a few more months, but it's just at a slower pace. So this 6.7% number should come down sharply in the next few months, and that should lead to a lower rate of overall inflation and also core inflation, because shelter CPI is just a huge, huge component there. So that's definitely the good news for Americans. And what we have in terms of the American worker is something that is just an enormous positive trend, where their wages, so the increase in their wages, is higher than the increase in inflation. And that's now gone on for 6 consecutive months. So for 25 straight months, I had to report this bad news, where we were seeing the opposite situation. And this is why consumer sentiment was so low last year. We hit record lows in terms of consumer sentiment, because their wages weren't keeping pace with higher prices. Today, for 6 straight months, their wages are outpacing the increase in prices. And that should continue for at least another month, because we're looking at the November CPI number is likely to be even lower than October. and wage growth is still exceeding that inflation rate. So very good news. And it's not just the US. We're seeing really a global trend this year of lower inflation. You have the Eurozone now all the way down to 2.9%. So it's really been a global trend, and this is likely to lead to a global shift in terms of central bank policy. And for now, it's that many central banks are on hold, whereas earlier in the year, many of them were still hiking interest rates. Now, many of them are on hold. And the question for 2024 is going to be, when will they be able to start easing? And we'll talk about that in the central bank section in a little bit in terms of what this inflation report, what impact will it have on Fed policy. So it wasn't just the CPI report this week. We got more evidence of cooling inflation in terms of the producer price index, up only 1% over the last year. That's well below its historical average. And so very good news there in terms of input costs are actually going down. And if we're looking at uh, import prices, now down 9 straight months on a year-over-year basis, so 2% decline over the last year. And what's driving that? Well, lower cost of shipping is definitely a big part of that. We've talked about this freight index remains below 2020 levels. So the supply chain issues that people were talking about in 2021 and 2022 are now non-existent. And we could see that in this supply chain pressure index that I like to illustrate actually hit a record low in terms of standard deviations below its average, which just means that supply chains are now functioning very well. There's limited pressure. So we can't use that as an excuse anymore in terms of inflation. And that should be very good news, because with easing supply chains and we have lower import prices, that's going to put less pressure on companies to raise prices. So good news all around in terms of inflation. Now, big question is, markets always looking forward. Well, what's going to happen with the next report that we're going to get in December, looking at November CPI? And so far, the data looks like it's going to be another good month. Another decline in CPI is likely. A few reasons why. Number one would be looking at gas prices, which are still down on a year-over-year basis, $3.34 a gallon now, the national average. That's the lowest we've seen since January. So good trend there. Hopefully that continues. And the commodity picture that I like to illustrate every month here, you can see most of the commodity components here are below CPI. So all of these factors should be a tailwind to help bring CPI even lower when we get that next report. Now, in terms of used car prices, is that likely to continue the decline? And the answer there is yes. We got new data in terms of November. We got the mid-month update for this Manheim used car index. Now, this is showing wholesale used car prices showed another decline, and this is a leading indicator, as we talked about, for retail prices. And in the last few weeks, I've noticed a significant increase in terms of the declines that we're seeing in terms of retail prices. So I look at this Car Guru's used car index, and it's actually now down to 28,400. Some significant declines in the past few weeks. I'm expecting this, if we're looking out through year end, to continue to decline because of these wholesale declines, and that's a leading indicator. So look out for that. It'll likely break below this low that we saw earlier this year. And that's very good news for anyone who's been waiting for prices to come down, waiting for what I've called a used car bubble to burst. Well, it appears to be finally light at the end of the tunnel here in terms of these prices coming down. And so, again, that's going to be another tailwind to help bring CPI lower. Cleveland Fed, as I often talk about, puts out this estimate, and their current estimate for November is for 3.1% in terms of overall CPI. And so very good news there. Core CPI, they're expecting to drop a little bit as well. But what we've seen is that core CPI even come in better than these estimates month after month. And it's going to be highly dependent on that shelter number. So expect that housing shelter number one of these months to just show an enormous year-over-year drop, and that's going to lead to finally these core prices catching up with overall price inflations in terms of the downside. So likely, we're only halfway through November, but likely to be another good month in terms of inflation. And so what is the impact of all of this on the Fed? Well, the market's now saying pretty much with certainty no more interest rate hikes from the Fed. 100% odds. This is not something you often see. 100% probability in terms of what the markets are pricing in for that last meeting of the year, and saying the Fed, there's no chance the Fed is going to hike rates. And that's a big difference from what we saw a month ago. You can see here, market was expecting pricing in a 42% probability a month ago in terms of the Fed could hike another 25 basis points. Now it's zero, essentially. And if we look at that expectation curve here, you can see markets expecting a few more pauses and then cuts to start in terms of the Fed funds rate as early as next May. And as I always say, this is likely to change between now and then. It's constantly changing, but clearly the CPI report has had an impact here, where you're seeing across the board just lower probability of future hikes, increased probability of cuts. And that terminal rate here has moved down significantly as well over the past few weeks. We're now down to 3.8% looking out 2 years. And just a few weeks ago, we were well above 4%. So overall, market saying there's going to be a dovish shift from the Fed sometime next year. If the market is right, at least in terms of their interpretation today, it could happen as early as May. But as we know, a lot of data between now and then could change that perspective. And from the Fed standpoint, there's not going to be, unless we see clear economic weakness, there's not going to be any urgency to cut. I think earlier than that, the Fed is getting what they want. They want lower inflation. They're getting it, and thus far they've gotten it without a recession. So for now, that tightening policy, that tightening bias, I think, is going to continue. So in terms of the Fed's balance sheet, similar thing here. They're going to continue to shrink this balance sheet absent a crisis in the markets, absent a clear recession. Now we have a 1.15 trillion reduction in terms of the balance sheet. That's the lowest we've seen for the balance sheet since May 2021 at 7.8 trillion. So this is likely to continue, and through year end, if it does at this pace, it's going to be the largest decline for the Fed's balance sheet on record for any calendar year. So just a continued tightening, continuing normalization, not anything extreme by any means. And for people suggesting the Fed is making a policy mistake, I would just suggest the policy mistake in terms of driving inflation up was done over here. It was done in keeping rates too low for too long. And now what they've done so far has merely been a normalization. It's not extreme at all to have a Fed funds rate of a little bit above 5% when you still have core inflation at 4%. That's certainly not highly restrictive policy by any means. So if we look at earnings and we look at the stock market's reaction, it's been a pretty good earnings season. And I like to zoom out a little bit and look at the trailing 12-month trend. So not just this quarter, but add up this quarter and the previous 3 quarters. And what we're seeing now in terms of S&P operating earnings is a new record high in terms of trailing 12-month earnings, something that not a lot of people were thinking about in 2022 when we had this dip in terms of earnings. The interesting thing to note here is that the dip in earnings was not nearly as big as the dip in stock prices last year. I think earnings were down on a trailing 12-month basis about 6%. As we know, stocks went down over 25% in 2022 in terms of the peak to trough drawdown. And so the market is much more manic than the actual fundamentals in terms of the stock market. And what is the S&P 500 and NASDAQ 100 doing? They're rallying rapidly off of their lows from a few weeks ago. And now we're looking at the both indices now less than 3% below their highs from early 2022. And this is on a total return basis, so it includes dividends. So not far off in terms of the two big major indices here, S&P and NASDAQ 100 hitting new highs. And if we look at earnings, that would be the clearest reason why people are optimistic. Earnings are at new highs. Sentiment's getting better. Fears about a recession are starting to fade. And so we're almost there. It wouldn't take very much at this point. You just need a few percent rally to get these indices back to new highs. So let's talk about the tech sector here, and really what's been since 2000. We have the tech boom, the tech bust, and now we have the tech boom again. And this chart really illustrates that. It's comparing the technology sector, the in the U.S., the S&P 500 technology sector versus the overall S&P 500. So it's just a ratio chart here. When it's moving higher, it means the technology sector is outperforming. When it's moving lower, it means the technology sector is underperforming the market. You can see the boom during the 1990s, which was probably the biggest bubble in U.S. financial history. And I think a few would question that statement. Clearly, just had extreme valuations back then across the board. Then we had that epic bust, that bear market that lasted a few years, did not bottom until 2002, late in the year. And after that point in time, it wasn't a V-shaped recovery for the technology sector by any means. I think a lot of that's been forgotten because of the gains of recent years, but it took a while, and we saw just over a decade of sideways action in terms of technology, just merely keeping pace with the S&P, but nothing extreme in terms of outperformance. And it's really been the last 5-6 years where we've seen just that huge surge in terms of the technology sector outperforming the S&P 500 by an enormous margin. And now we have that ratio back to March 2000 levels. So technology boom, technology bust, and in recent years, another technology boom. Another way to illustrate this in terms of comparing the S&P 500 technology sector to the S&P 500 overall is looking at the last 10 years. And just incredible here, that S&P technology ETF, first of all, back at new all-time highs. So we just talked about the S&P still has a few percent to go. Tech sector already at new all-time highs. But look at this performance differential here. Over 500% gain for the S&P Tech ETF over the last decade versus 200% for the S&P 500. So it's been a great last 10 years for the overall market. That's an annualized return of about 12% per year. But the S&P Tech sector just trouncing everything else. That's a 20% annualized return over the last decade for tech stocks. Haven't seen, of course, anything like that since the 1990s. And the question would be, is the next 10 years going to look anything like that? And the answer is most likely not. 20% gains annualized over a decade is just very rare to see in market history. Just compounding of that, the math of that, as you can see here, 500% gains means that it's a 6x increase over 10 years. So keep your expectations in check. That doesn't mean technology is dead. Technology, of course, isn't everything. But in terms of the gains that we saw in the last decade, this is highly abnormal, doing 20% per year for a decade. So let's switch gears here, looking at the manufacturing industrial slowdown. Whereas the overall economy still in an expansion. If we're looking at the manufacturing sector, something a little bit different in terms of the picture there. If we're looking at this ISM manufacturing PMI, it's now lower than 50. So readings lower than 50 are indicating that the manufacturing economies is contracting. These are surveys that are done every month with a lot of different companies. And now it's been 12 straight months that were below 50. And I was just comparing this to other cycles where we saw recessions or decent periods of contraction. So 08, 09, we had 13 straight months below 50. 2000, 2001, we had 18 months consecutively below 50. In the 1990-91 recession, we had 13 straight months below 50. So at 12 straight months, other than these other recessionary periods, we really haven't seen that. Now, does this mean necessarily U.S. economy is in a recession or going to be in a recession? As we said, not necessarily. Manufacturing is only about 11 or 12% of the U.S. economy. So as long as the service sector can continue to expand, the U.S. economy is not going to dip in recession just because of manufacturing, but definitely a data point, definitely notable to have this type of weakness for this long. And if we look at industrial production data in terms of the last year, what we've seen is actually a decline of 0.7%. Not a huge decline, but biggest decline we've seen since 2021. And you can see during recessions, you tend to see even bigger declines than this. So if we are into recession, we likely see further declines. But you could also see, and we saw this back in this period in 2015, 2016, we've had periods where industrial production has declined without a US recession. So just another data point here. Not everything is showing very strong growth. We have this manufacturing industrial production slowdown, and the question is this going to reverse or it's going to continue to trend in this direction? So what else in terms of the economy is showing signs of weakness? Retail sales. I've been mentioning this every month for a year now, and the reason for that is that we've seen inflation adjusted retail sales now decline on a year over year basis for 12 consecutive months. That's the longest down streak we've seen since 2008, 2009. And so looking at nominal retail sales doesn't tell the full story, especially during a period of high inflation. You have to adjust for those rising prices. And even on a nominal basis, retail sales have been pretty weak over the last year, up 1.6%. That's compared to historical average around 4.7%. So definitely below average. But if we're looking at adjusted for inflation, this is now a pretty long time. You don't tend to see this long of a period of negative retail sales adjusted for inflation for 12 straight months. So this is going to be a factor for markets if it continues, and certainly if it weakens, because the U.S. consumer, of course, is a big driver of economic growth. And so we got a few earnings reports this past week in terms of that retail sector. Home Depot, similar to what we saw last quarter, and we talked about it back then, we're seeing, this is the chief financial officer said, we're seeing a period of moderation in terms of home improvement where people were doing big jobs or doing just remodeling their entire home, and now they're just doing sections. So in terms of one example he gave was, instead of doing their entire kitchen, maybe they're just going to do a countertop and backsplash. So just pulling back moderately from what was, by all accounts, a boom in terms of spending on housing, and with the stimulus and people spending more time in their homes, there was just an absolute boom in terms of spending there. But we also have data from Target, had negative sales growth there as well over the last year. And same as last quarter, what was the Target CEO saying? Well, they're cutting back on discretionary purchases. They're not buying much more than necessities, hunting for lower prices. And so we saw comparable sales for Target down year over year. So here's a chart illustrating revenue growth for both Home Depot and Target on a year over year basis. You can see both of them declining. And for Home Depot, it's been a very rare thing to have a few quarters here of negative year over year growth. You have to go back to 2008 to 2009 to find that extended period where people were spending less at Home Depot. And you can see just the unprecedented boom we had in terms of consumer spending and retail sales during 2020 and 2021 after those rounds of stimulus. Now, some of that stimulus was saved, but a good portion was also spent. And the number one area that people spent money was in terms of home improvement. So places like Home Depot benefited on that enormously. And now you just have that normalization where a lot of that savings is starting to be depleted, and people are spending less than they were a year ago on things like that. So what's the indication for the holiday season? This is always a big question heading into Black Friday and heading into December, because a lot of these retailers get a good portion of their sales, their income for the year in this period of higher consumer spending. And the early read is that so far we're seeing a lot more discounting than what we saw in the past few years. And looking at this data here, we're seeing a 24% average discount in terms of these retail locations, and we're actually seeing more items being discounted than years past. So you can compare this to 2021 when we saw that record boom in terms of consumer spending and retail sales. You had much fewer discounts, much fewer items being discounted. So this will be interesting to watch if this translates into lower spending this holiday season. So far, retailers are having to put more items on discounts to try to encourage higher sales. So I want to talk about the secular shift to e-commerce, and I don't like to go to retail stores, but things like this certainly aren't helping. When you go to a store and items are locked up, and you have to wait for someone to open it up, things like toothpaste. Well, that's not convenient whatsoever. Target CEO actually said that customers are thanking them for locking up their merchandise. I don't believe this to be true. There's a survey done that said this was definitely not true, that many of these customers would shop elsewhere if their items are being locked up, and 26% of them would move online. And I think that is the case for many people, where it's just already so much more convenient to shop online. And this has been a secular trend that is going to continue. And there's very few things you could say for sure in terms of an economy, but for sure, the trend of more sales going online is going to continue in the years to come. Only question is how fast and how much. And you can see how far we've come since 1999, when we had 0.6%, so less than 1% of total retail sales came from e-commerce in 1999. Today, we're up to 15.6%. And where will it be 10 years from now? My guess is certainly above 20%, and could be even more than that. And this is the one secular trend in the economy that you can definitely expect to continue. So let's talk about national debt and when it starts to matter, because for many years people said national debt doesn't matter at all, and therefore we could just keep borrowing as much as possible. And they did that in 2019, 2020, and 2021. We saw that huge record increases in terms of national debt. But since then, even though the economy is back in an expansion, we're still borrowing like crazy, hitting these $1 trillion milestones every few months. And I suspect we're at 33.7 now in terms of the national debt. We're probably going to hit 34 trillion at some point early next year. So we'll update this chart again. But the saying for a long time was, ignore this, doesn't matter. And the reason people were saying it doesn't matter is because interest rates are so low. So if interest rates are 0%, the Fed's keeping rates at 0%, you can borrow short term for almost nothing. And who cares how much debt you have, because servicing that debt is very easy. Well, that game has changed with the 10-year rising all the way up to 5% of late. And we also had, of course, the Fed hiking rates above 5%. So the combination of that with higher debt levels, higher interest rates, means more interest expense. And so the latest data that we have in terms of what the government is spending on these interest payments is this: 924 billion over the last year. And that's obviously a record total. And you can see here just the acceleration in terms of interest rates. At first just normalized, and now interest rates are going up pretty rapidly. And what a missed opportunity that the federal government had back in 2020 in terms of they could have borrowed long term. They didn't do that. They borrowed short term, and now the bill is coming due. All of those securities, those short term securities that they issued back then, are coming due at much higher interest rates. So at some point in early 2024, this is likely to cross above $1 trillion. And still, the amazing thing is, it doesn't seem to be a huge issue in terms of the political landscape. We're not hearing very many people talking about it. So I expect it has to get worse. It has to become more of a crisis before we actually start to care about this and tackle this issue. So why should people care about the national debt? Because at a certain point, this interest expense is going to crowd out other spending. It's going to hamper growth. When you get debt as a percentage of GDP above a certain level, historically, if you look at other countries, it tends to crowd out economic growth and cause long-term problems. So it's very easy to kick the can down the road, pass it off to another generation, just say, we'll borrow more today and let that next generation worry about it. That seems to be the plan, but hopefully we'll start to tackle it before it gets to a point where we can't come back for it, or it's very difficult to come back for it. So there's still time, and there's still things that can be done. Obviously, number one would be start attacking that deficit and running trillions of dollars in deficits during a period where the economy is in an expansion. definitely not a good idea. So start there, and we could work from that standpoint. But I think, unfortunately, it's just going to have to get worse before it gets better, because people don't seem to care about the debt until it becomes an actual crisis. So let's talk about the housing market here very quickly. Higher rates, lower home builder confidence. It's obviously intuitive, more expensive to build a home with higher interest rates, and you have less demand from the consumer. So what we're seeing is a continued decline in terms of this housing market index that measures home builder confidence, now down to 34. So pretty sharp reversal. We saw a brief period of higher confidence earlier this year. Well, that's come right back down. And in the latest report that we have, 36% of builders reported cutting their prices to try to incentivize more demand. And their average cut in terms of the price was around 6%. So what is this lower confidence translating into in terms of building? As you might expect, the combination of higher interest rates and in terms of lower confidence and lower demand, well, they're building less. And if we look at housing starts here, just languishing here, still down on a year-over-year basis, and just stunning to see housing starts compared to the U.S. population. So population has nearly doubled since 1960, and we have really the same level of housing starts. And we've talked about this a bunch of times, but we simply have a housing deficit in this country. We need many more homes, and we're just in the situation today due to interest rates, due to other factors, that home builders aren't building enough homes. And so hopefully this will turn around. We'll have more supply, and this situation will change, because one thing that would be helpful in terms of the unaffordability of homes is to have more homes. That would help more supply, that would help lower prices. And as we talked about, you have just many more households being formed than homes being built over the last decade. And that's just contributed to the situation. We had a bad situation already in terms of a housing bubble. And what's made it worse is this very low supply. So it's going to be a continuing issue. It's not going to change overnight. So the best thing that we could see would be home builders starting to build more homes again. So I want to end, as I always do, with something positive. And what I'm thankful for this year is lower food price inflation. And this chart here, definitely good news. The average cost of a Thanksgiving meal is actually down 4.5% from last year's record high. Yes, it's still 25% higher than 2019 prices, but thankful that it hasn't continued to increase, actually lower than it was a year ago. Part of that is the lower prices of turkeys. Last year, we were talking about just the crazy increase in the prices of turkey, and some of that was due to the bird flu and shortages there, and that's been rectified and then some. And we're looking at the average turkey wholesale price down 32% year over year. So why isn't the Thanksgiving meal down 32% year over year? Well, the orders for the turkeys that you're in your supermarkets today are done early on in the year. And so a lot of that was bought already at higher prices. So if these prices stay low next Thanksgiving, we should see a much bigger drop in terms of the average price of a Thanksgiving meal. So hopefully prices stay down. We've seen this in terms of chickens as well, and egg prices. So that's been very good. And all of that's been driving lower overall food price inflation, which to me is the best statistic that we got in that CPI report, was that food price inflation, food at home, which is the grocery store essentially, up 2% over the last year. That was the lowest food price inflation that we've seen since June 2021. And I would love to see this go down even more and actually go negative on a year-over-year basis. That would be awesome. But thankful that we're at 2% today. We peaked last year, 13.5%. That was a terrible situation for many Americans, because needless to say, people's incomes were not going up anywhere near that amount. So with that, we'll end it right there. Thanks everyone for joining me. Have a great weekend. Have a happy Thanksgiving. If you like the content, as always, subscribe to the channel, and I'll see you next time on the Week in Charts.